We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Alasdair Macleod, author of the Macleod Finance Substack. Alasdair, thanks for joining me today. Good to see you again.
That's my pleasure, Tom.
So, Alasdair, this has been really a nonstop year for news and things really happening in the markets. And as complex as all of this can be to understand, one piece that you recently wrote about on your Substack was the ECB's warning of the increasing counterparty risk in gold derivatives in the euro area. So this kind of stems from the situation that we saw at the beginning of the year with lots of physical gold being demanded out of the LBMA and out of the euro area, as you put it, and being brought into the States, into the COMEX system as a, kind of front running all of this all of these tariff issues. So how are we to understand this warning, and how did the ECB see it as posing a systemic risk?
Yeah, it's an interesting story, and I'm glad you brought it up because no one else other than the ECB and me seem to have placed an emphasis on the fact that COMEX has become a delivery option. The stands for delivery are enormous. The rate at which they're running in this year so far is an elevated 1,500 tons a year. That is huge. It's a lot faster than in over the last 3 or 4 years following the pandemic.
Alasdair, I believe it's annualized. That 1,500 tons is, that's magnitudes of order larger than the last 4 years combined, is it not?
Well, the last 4 years combined was 2,100 tons.
Okay.
So what we're seeing, you're about right. What we're seeing, if you like, in this year, if you like, is 1,500 as opposed to roughly 2,000 the last 4 years. Okay. So it is about 4 times the pace. Mm-hmm. The thing that generated this originally was the sudden realization on COMEX that they've got outstanding stands for delivery. And from what I understand, there might be quite a backlog of these stands for delivery because, when you talk to people, Rafi Faber was one guy who decided to test the system. And he bought one contract and stood for delivery, and he had a hell of a problem getting delivery. He really did. They delayed. There's another guy who is a dealer for Sprott who took delivery of silver, or at least tried to. And I think that story is somewhere on Garter in one of their dispatches. It took him forever to get it. It really didn't. There was excuse after excuse. He sort of thought, well, should we sue the deliverers for this? And, they took legal advice and decided not to. And I suspect, actually, that from Sprott's point of view, if they tried to sue, say, one of the big bullion banks, they'd probably be cut out of COMEX forever. So that I could see as a retaliatory action. You can't rub these guys up the wrong way. But nevertheless, there's probably a huge backlog of delivery. We just don't know. We don't know. But I think it's worth assuming that there is some backlog of delivery. So with the prospect of tariffs coming in, of course, a bullion bank operating on COMEX had the problem that they were potentially going to have to pay 25% more, including the tariffs, to ship the gold in to COMEX in order to deliver against those obligations. So basically what happened was that they jacked up the price of the futures, put a huge great premium on the futures to create an arbitrage. Now, this sort of arbitrage always works. People will beg, borrow, and steal gold at one price to get the gain, if you like, on another price. Now, if you've got your own gold and you don't particularly care whether you've got it or not, then that's easy. The arbitrage is just a one-way ticket. Basically, you sell it and they say someone's bidding me 20% more than market. Yeah, I'll take it. Bang. If on the other hand it is a genuine arbitrage and it's not your gold you're doing, but you're sourcing gold, say from the Bank of England's vaults under, let's say, a lease agreement or something, or dealers in Zurich or wherever it might be, it's not your gold. What you're doing is you're taking this gold at one price and you're selling it into the market at another price. Are you going to get that gold back? Well, no, because it's all being used to satisfy the stands for delivery. But the ECB's point was that banks in the euro system, or the euro area more correctly, were covering the price risk by taking out derivatives. And I would guess that the price risk would be something like, sort of out of the money options or something like that. I mean, it depends how they see the risk, but there would have been, or dealing forward, whatever. I mean, you can match the liability through derivatives. There's so many ways in which you can do it. Okay. So that's why they reckoned that the derivatives, outstanding derivatives, rose 58% compared with the period last year. This is a huge, great jump. But the problem is that the banks delivering this stuff into COMEX might have been trying to cover the price risk, but they can't cover the risk that it won't be delivered back to them at the end of the period. So, in other words, we are potentially looking at a huge, great default on the derivatives. Whether it's London derivatives, forwards, or whether it's options or whatever, there's going to be defaults by the look of it. What happened in the past is that the central banks, through leasing arrangements and the BIS through dealing and all the rest of it, would ensure that a squeeze on delivery in gold markets would be dealt with by, a supply, if you like, of more leasing, rehypothecation, and all the rest of it. So they would come to rescue the system, if you like, when it comes to the other side of the deal. But the problem is that central banks who have been quite happily leasing in order to get an income from what is otherwise an asset which earns them nothing for their reserves, they're now beginning to think, well, hold on a minute. If our gold is gone, do we really want to do any more leasing? And the answer to that is no. So as the leases expire, they're not going to get renewed. And I think this is a general problem. And it's something that the market doesn't really realize. And interestingly,
because of this jump in demand for actual physical delivery, right?
Well, it's gone. It's gone. I mean, the question to be asked is who is actually standing for delivery on COMEX? Mm-hmm. And the only people it can possibly be are people who can't get bullion elsewhere and are using futures as the means of taking delivery. In other words, they will buy into a future and stand for delivery. That's the only way in which they can get it. So this suggests to me that what we're looking at is, say, the second and third tiers of central banks. We're looking at various sovereign wealth funds. And we're also looking, and this is all dealing on Globex, incidentally, we're also looking at, I think, some of the really wealthy Asian families. They also will be looking to take delivery of physical, because just the same as, I've been talking about the risks in the fiat currency credit system. I've been talking about this for a long time. And I find that people around the world are beginning to realize, yes, this is a problem.
Mhm.
They're awakening to it. It's a slow process. But you have these, what I might call my fellow travelers, who have been increasing in terms of their demand for physical gold, really over the last 3 or 4 years. And then along comes President Trump. And guess what? They don't actually want to hold dollars anymore. They want to get out of dollars. And if they're getting out of dollars, they really don't want any other fiat currencies. And so consequently, they stand for delivery in increasing quantities of gold on COMEX. It's the only way they can get it. Because if they go to a Swiss refiner, for example, and say, I would like some gold, 2 tons or whatever,
Mhm.
the Swiss refiners say, well, join the queue.
Well,
They go to
Alasdair,
the bank.
I was going to
Sorry.
say, I think this is a really interesting point that, I've asked guests in the past here is like, who is actually standing for delivery? And I think this is a good way to kind of go about understanding who is actually standing for delivery, because I would assume that because of this mechanism of delivery, where you're buying futures that have very little premium attached, let's say, that gives you a clue to the size of the entities that are standing for this delivery, because it's not like you can't get gold, right? You could theoretically just go to your local bullion dealer and buy, some 1 kilogram bars, but not in sufficient quantities, let's say, for maybe a sovereign wealth fund, and or not in the preferred premium tier, let's say, that you would by standing for delivery by taking a futures contract, right?
Absolutely. I mean, what we have is demand which is in the millions of ounces, not the odd kilo bar. I mean, this is
tons of literal tons of gold.
Absolutely,
rather than
Now, obviously, it's not just one entity standing for tons,
Mhm.
but it's interesting that when you see the expiration of a contract, the quantity that's being stood for is really quite amazing. I mean, you're looking at sort of 10, 15, 20 tons on contract expiry. Now, these are significant amounts. Your problem is that if you go to, say, the London market and you try and buy gold there, I mean, yes, you can get some gold. Getting delivery, not necessarily quite so easy. But the other problem is that the way the fixing prices works, you find your order is front run by the bullion banks. This is not easy. And not only that, but, if you're operating from the depths of Asia somewhere, you may not be quite persona grata in London. So, I just don't know. We just don't know. We can only surmise that these stands for delivery are not the normal operators within the system who would then take the view, I have got a profit on my investment, so I'm perfectly prepared to sell it back into the market, say if gold rose to $4,000 or something. It's not that sort of business, in my view. And what this means is that I think what we had at the beginning of this year, when we saw the run literally on the Bank of England's vaults, we've seen only part one of the story. Part two of the story will be when various central banks decide not to renew their leases, and those who borrowed gold to sell it into COMEX find that they're not getting it back. This is really quite serious.
Mm-hmm.
So I think we're storing up huge, great problems. And it's not just gold, Tom. Also, it's exactly the same situation in silver.
Mm-hmm.
I mean, just look at the COMEX vault figures. I mean, they've gone right up through the roof. The gold warehouse numbers have dropped from the highs. I mean, I think it's sort of down, sort of a couple of million ounces or something. But it's hardly dropped at all in silver. So the squeeze is still on in silver. This is it's a very interesting situation. interesting.
And this is the point that I wanted to kind of underline at the end of this is that, despite the catalyst for this physical run being the tariffs at the beginning, and then having the clarification that gold and silver are now exempt, this situation seems to persist because of the leverage ratios by many of these financial institutions and entities within the space, right?
Yeah. Yes, essentially what we have is a situation where there's just no liquidity in the market. I mean, not in the sort of sizes we're talking about. Mm-hmm. It is a consequence, really, of gold disappearing into places like China, in particular, and also other Shanghai Cooperation Organization and BRICS members, who are all doing the same thing, basically. And they're not just doing it for central banks. Sovereign wealth funds are doing it, and so on. So, the demand, if you like, on refined gold is really very, very substantial. Mm-hmm. And I would guess that the COMEX stuff would probably be remelted down into standard, the Chinese 1 kilo standard, 4.9 standard. I think that's where it's all going to end up, basically, around Asia. Mm-hmm. I think quite a lot of the demand is probably also going to be from the Middle East. I mean, particularly countries like Saudi Arabia. I would have thought the crucial states as well. I think they're beginning to accumulate gold. I mean, these are the potential. I mean, and particularly around that part of the world, a lot of the demand is likely to be from wealthy Arab families. Whether they're the princely families in Saudi or whether they're wealthy businessmen from Dubai and Abu Dhabi and Qatar and Bahrain and so on. I mean, it's all grist to the mill to them. And of course, you've got a huge, great souk in Dubai. So you could have refiners there who've just got jewelry demand, which is continuing. Seeking, I mean, they don't mind whether it comes in the standard COMEX 100-ounce bars. They really don't care. They're going to melt it down and turn it into bangles. So, yeah.
Mm-hmm. So, Alasdair, how does this, is this maybe the beginning of a symptom of the rest of the world kind of recognizing the situation that the US dollar and the US debt markets are in? The Fed has left rates unchanged while the rest of the world is dropping, seeming to be dropping interest rates. One would think that this would, drive capital into the US debt markets because of the comparably higher rate. But if we see, this proportion of gold, let's say, replacing treasuries and bonds as a more neutral store of value, is this a recognition by the rest of the world that the debt trap or the debt situation, the debt calculus of the US dollar and US debt is in fact, not attractive enough anymore?
Yeah, indeed. I mean, I think this is a process which has been happening in recent years. We now have a situation where I think there was a chart produced by, I can't remember whether it was the World Gold Council or one of these entities, which showed that there's, in terms of central bank reserves around the world, there's a higher level of gold ownership than dollars now. It's, it's sort of overtaking. I don't know if that's entirely true, but it was a chart which somebody produced on X, which struck me as interesting. Mm-hmm. The other symptom of this is the difficulty which America has in funding its government debt out along the yield curve. It's becoming progressively more reliant on T-bills for its funding, as opposed to, say, 10 and 20 and 30-year maturities. Mm-hmm. Nobody really, apart from tame pension funds and maybe some insurance companies who write that sort of long-term business. Nobody else really is interested in buying long maturities. So these auctions are always very disappointing, and it has the effect of quickening the pace, if you like, of the refinancing that's going on all the time. I think it is becoming more widely recognized that with budget deficits running at 6.5% to 7.5% year in, year out, with an underlying economy which is probably not growing anymore, the US is really in a debt trap because it's not getting the potential increase, if you like, in tax revenue to cover the increased cost of borrowing an increasing mountain of debt. Because the US government never pays interest. It just rolls it up, rolls it up, rolls it up. So this is a debt trap now, which I think is more widely recognized. It's no longer just a question of China deciding that it wants to remove the dollar from its transactions as much as possible and replace it with the yuan. We've moved on from that. I think there is now a wider recognition that the dollar itself is in trouble. Mm-hmm. And you've only got to look at the trade-weighted index to see, it looks ghastly. It's very, very bearish. So it's hanging around at the moment. Most markets are just hanging around at the moment. This is a sort of summer lull, if you like. It's selling in May and going away. It's just, I think it's probably modify that and say, just put your positions on hold, go away in May and just have some holidays. Nobody's interested. We seem to be on the brink of World War III. And what do the markets? They just shrug.
Well, that's
extraordinary.
That's something that I wanted to get into. Over this past week, we've seen the tensions with Israel and Iran materialize into attacks from both sides. And initially, gold did respond, and it has kind of sold off through the rest of the week here. So, do you see the markets as maybe seeing this conflict as less consequential for the rest of the world and the markets than we would assume at this point?
Well, yeah. First of all, about gold in this case, to my mind, when we look at gold, we look at actually an exchange relationship between gold and principally the dollar. Mm-hmm. And so it's the dollar's problems which benefits the gold price in that relationship. I think we've got to bear that in mind. The idea that war is good for gold is not necessarily the case. War tends to be better for, if you like, for the dollar. You find that people are going for a safe haven. And the safe haven of the dollar, which has been traditionally certainly since before the Second World War, and particularly in the last sort of 30, 40 years, that safe haven aspect is something which is, with all the capital that there is around, investment capital that there is around, that's what you're told. You're told that the safest thing to do is to hold US treasuries. Mm-hmm. So when you got the threat of an escalating war in the Middle East, what do? You buy more dollars and you buy US treasuries. So I think that is really where the benefit, if you like, of this disruption tends to go rather than into gold. That said, I think, if you consider the implications of this and assume that we're not going to stop dropping nuclear bombs all over the place, then under those circumstances, you can see that, this is the sort of uncertainty which actually could backfire on the dollar, not so much from the fact that there's, the war is going on, but more from the fact that it's destabilizing US finances. That's the sort of equation that you'd be looking at. I think that I think that as far as gold is concerned, it's had a very, very good run against the dollar. We've got a pause in the dollar, and I think the pause is in the dollar rather than anything else. If you look at the trade-weighted index, I mean, there's been movement out of the dollar into euros and into yen as well, to a very large extent. Those are the two principal currencies, if you like, which are in the the trade-weighted index. And I think that's just gone on sort of pause a little bit. So the dollar has looked very, very weak against other currencies. A little bit of a pause. I think it'll go south again. But of course, the pause is reflected in, if the dollar's pausing in terms of its loss, then the exchange rate with gold will also pause. And that's really all we're seeing. It's interesting that gold is actually holding up extremely well against the dollar. But that's a function of the dollar really just moving sideways, more or less. I mean, if you look at the trade-weighted index, I think we got down to something like 97.5. We're currently about 99, and it's just been moving in that sort of range. Mm-hmm. It could perk up to 100 and test that. In which case, the gold, the dollar gold exchange rate will probably mean that gold goes down to, I don't know, sort of 3,200, whatever. So you can see that that's really, I think, what's going on in a very, very quiet time. I mean, if you look at COMEX, gold is not overbought. I mean, this is the extraordinary thing. I mean, we had this run up in gold at one stage to 3,500, just very briefly on a spike. But if you look at the open interest on COMEX, it's been very, very low. Mm-hmm. It's currently just a bit under 450,000 contracts. That is low. It's been down to, I think, just over 400,000 contracts. That's pretty oversold. So how do you get a gold price which rises like that and nobody's buying it on COMEX? I mean, what gives? COMEX is just, it's just not in the equation. Silver is very, very different. The people have been really going for silver. And it's even, I mean, the idea that it's the managed money who really pushed it and so on. But in fact, the managed money has got quite a bit of room to push it further. So has the other two categories, the non-reported and the others. They can go quite a bit further in terms of their net long positions. And already we're up to 180,000 contracts, which for silver is pretty high. So it's a big squeeze. I mean, the squeeze is worth around about $9 billion at current levels, spread amongst the swaps principally. Because the other thing that's happened is that the producers, the mines and so on and so forth, have not really increased their net short position by very much. I think that side in the past has been very much banks operating for the Chinese government, because they have, there's no doubt in my mind that they have had a long-term plan of keeping the silver price suppressed. I think that's changing. I really do. So it's interesting times in this pause.
So explain to me the incentives involved from that perspective, Alasdair. You said that the Chinese banks have, let's say, an incentive to have kept the price lower. Let's say, would that be for industrial demand, for building of solar panels, stuff like that? It's not the banks, it's the government.
Okay. I mean, I first worked this one out when I had a speaking engagement in New York, and it was about, 10, 12 years ago. Mm-hmm. There were lots of silver mining companies and exploration companies exhibiting at this conference. And I went round them all because at that stage, the sort of gold bug community or silver bug community was accusing JP Morgan of rigging the market and all the rest of it, and Blythe Masters, lying through her teeth. She had actually at that time, I think it was 2010-ish, she had actually deliberately gone on CNN and said, we do not take positions for ourselves. We only take positions for our clients. And of course, everybody said, oh, she's lying. But I know people like this. I've worked with people like Blythe Masters. They do not lie. I can tell you that for a fact. They will protect themselves in any interview or anything they do. They will not tell a barefaced lie, which was what she was accused of doing. Mm-hmm. So I then knew that JP Morgan was not acting, if you like, to suppress the price off its own book. It must have been doing it for someone else. So my question to all these silver mines was, tell me, how do you turn your silver into cash to pay all your miners and your energy costs and all the rest of it? And they all came up with the same answer, which was interesting. They said, man from Gencore comes along, he values the doré, we get paid for that, and it gets shipped off. So where does it get shipped off to? They said, well, we don't really know, but we assume it's China. Right. We could then see how this worked. In other words, the Chinese would pay for it. Yeah, the Chinese would pay for the doré.
Okay.
And that goes outside the market. Mm-hmm. And at the same time, they would instruct JP Morgan to sell futures to suppress the price. So they managed to keep the lid on the price the whole time. Now, bear in mind that at that time, countries like Canada were closing down silver refining businesses because it's ecologically dirty and all the rest of it, and not productive. And the Chinese, I think, also were doing it more cheaply than anyone else. So an awful lot of silver doré from the West was going into China. Now, China themselves was something like the 5th largest mining nation of silver. So they were also mining it themselves. So they were stockpiling it. Now, the other side of this story, I think, is very important. And that is that back in 1983, the Chinese Communist Party appointed the People's Bank of China sole responsibility for managing the state's gold and silver reserves, acquisition, sales, whatever, the whole thing. And I mean, the Shanghai Gold Exchange, which deals in gold and silver, is a wholly owned subsidiary of the People's Bank of China. So I worked out how they dealt with the gold. That was quite easy. But silver is interesting, and we've forgotten to look at silver. But basically, the People's Bank of China has been in there dealing in silver, buying silver, hoovering up all the loose silver it could get around the world. So it has built not only its gold reserves, but also its silver reserves. Now, silver has been used, as you pointed out earlier, as an industrial metal. But don't forget that from the Chinese point of view, their last metallic standard was a silver standard in 1935. Whereas, I mean, Europe went off silver in 1873. So you can see that China's experience of silver is a lot more recent, if you like. And therefore, that's still somewhat in their psyche. I think they look at the gold-silver ratio and think, "My God, silver's cheap." Interestingly, 2 years ago, I think in 2023, China exported quite a bit of silver. And that silver didn't go to producers of photovoltaic cells. It went to Hong Kong. It went to London. I think it went to Singapore. I mean, it was going to financial centers. So they were still managing the price. Now, that in 2024 didn't happen. They still exported silver, but that was going to industrial users, basically, presumably for photovoltaic cells and other applications. I think they've taken the view, and particularly since Donald Trump started talking about tariffs and all the rest of it, that, right, in line with their views on rare earths, they say, right, okay, that's it. We're not exporting anymore. And I think that's created the crisis, a crisis on top of a similar problem with silver on COMEX that they had with gold.
So, Alasdair, let's make this a little bit more explicit then. If the Chinese government is now, let's say, ending this price management on silver, yeah, is that because it suits their needs or their incentives because they have enough, or how do you look at that?
Well, I have no doubt that they've got a substantial quantity of silver. They don't tell us how much, just the same as they don't tell us how much gold they've parked around, the People's Liberation Army, the youth wing of the Communist Party, etc., and all these various accounts where they've parked, in my view, at least 30,000 tons of gold. I mean, we're talking huge amounts. So on that basis, I think the big change, really big change, was President Trump on his Liberation Day saying, with his boards, these are the new tariffs. We're going to charge the penguins 35% in Antarctica, or what and the Chinese. And then he went up to 140. I mean, literally, just following that, China announced that they were going to speed up their trade talks with South Korea and Japan. Mm-hmm. And they also then started looking at their relationship with the other ASEAN nations, the nations, if you like, in East Asia. So President Xi then had a whistle-stop tour the following week, where he went to Myanmar, he went to Vietnam, I think he went, I can't remember whether it was Cambodia, and you got all these big countries with actually a pretty large Chinese diaspora, which are naturally, if you like, in China's pocket in this sense. And what China did, I mean, obviously she was talking about, look, we got to get this trade amongst ourselves to really get going, to replace our dependence on America. But the other thing we didn't know, which I suspect is definitely the case, was that she was also talking about the future of the currency, the future of the yuan, and how that will replace the dollar for ASEAN and South Korean and Japanese trade. And that replacement was going to be facilitated by the Shanghai Gold Exchange opening vaults outside China for the first time. And already we've had one announced in Hong Kong and one announced in Saudi Arabia, whereby you can take gold, put it in, take it out against a currency, only one currency, and that's Chinese yuan. Mm-hmm. And they listed what instruments you could use to swap for gold. So this is actually putting the yuan onto, we'll call it for the moment, a floating gold standard. It's clear to me that China's long-term strategy is to protect itself from a collapse in the dollar. Not to bring it about, not to accelerate it, which the Russians would be very happy to do, which is why they were talking it up over BRICS in 2023, ahead of the Johannesburg summit. But the Chinese take this view, we've been around for, 3 millennia, whatever. We're going to be around for another 2 or 3 millennia anyway. Why hurry? And they also take the view that the Americans, who are pretty brash, make all the mistakes. So we don't need to do anything. They just screw it up themselves. But we do need to protect ourselves. We need to protect ourselves from a collapse of the dollar, which they know is going to happen. Mm-hmm. And that protection, basically, at some stage, I guess, the plan is that they will fix the yuan. It'll be the overseas yuan. And, I mean, it should also be the domestic yuan, but at the moment they've got exchange controls. It'll be the overseas, the international trade yuan. They're going to fix that to gold at the appropriate moment. But they don't want to do it too soon because they don't want to destabilize the Western currency system for 2 reasons. Firstly, they depend on it for trade. They also depended on it for their own credit creation and the management of their currency. And they don't want to be blamed for it. They don't want to be blamed for the collapse of the post-Bretton Woods system. Mm-hmm. But it's happening.
And considering how much, let's say, U.S. debt they hold as well, it would seem that to crash the value of the debt that they hold, that wouldn't serve their interests either. On face value.
Well, that's right. I mean, it's a bit of a problem for them because they can't really get out of the dollar entirely. I mean, that would crash the dollar. Mm-hmm. And also it would drive up their own currency against the dollar and against all the other currencies. So that option isn't on the table. I think they've probably hedged their exposure to the dollar quite a lot. The other thing they've done, I think, is they've loaned dollars elsewhere, and sort of got rid of them that way. So the various ways in which I think they probably lessened their exposure to the dollar, but there is no doubt that the collapse of the dollar is going to cost the state quite a lot. But on the other hand, they would more than make up for it by all the gold that they've got hidden around various accounts, not in the reserves or indeed in safe, the wealth fund, which is actually managed by the People's Bank.
Mm-hmm. But do you think that happens at a much higher gold price?
Well, I mean, the collapse in the dollar, it's not gold going up, it's the dollar going down. So, the dollar goes down to zero, reflected in an infinitely high price in dollar price for gold.
Right.
It's as simple as that. The problem for the rest of us, of course, is that either other countries are doing exactly the same thing as America. I mean, we've all got high debt to GDPs. We're all getting into a debt trap. And so the whole thing is an international mess, a global mess, if you like. It's certainly amongst what used to be called the advanced nations, the G7. Mm-hmm. The G7, honestly, what a shower. But we're all in the same boat. The dollar goes, we go with it. And I think to look at it in terms of sort of inflation is actually looking at it the wrong way around. It's just the purchasing power of our fiat currencies are going to collapse. I mean, it's the end of the post-Bretton Woods system. This is something which we've known for some time. I think there was a guy called Zoltan Pozar who was with Credit Suisse, mm-hmm. who came up with this meme that it's sort of we're going to go into Bretton Woods 3. You have Bretton Woods, you have the fiat currency system, and then there is a new system going to evolve out of that. It's and that basically will mean that either our currencies, our governments would have to go on to something to stabilize the value of their credit, or their credit goes down in terms of its purchasing power. And that's where we are. I mean, certainly there's no political will to address this problem at all. Mm-hmm. And the reason, coming back to what we were talking about earlier, the reason that you can't fund anything out along the yield curve is because foreigners don't want to buy this stuff anymore. Mm-hmm. They don't want this credit. I mean, we might think that dollars and pounds and euros and yen are money. No, they're not. It's just credit. That's all it is. And you got, it's a medium of credit under which you acquire more credit. So you have dollars. You might have it on deposit with an American bank. So you've got the dollar credit, and you've got the credit with the bank. Or alternatively, you might put it into bonds, in which case, that's a different form of credit. But I mean, foreigners own, on the last US Treasury tick figures, they own $39.6 trillion of double credit, what it boils down to, double credit. Do they really want that? 17 trillion of that is in equities, incidentally.
What do you mean by double credit?
I'm sorry?
What do you mean by double credit?
Well, you've got the credit exposure of the currency, and you've got the credit exposure of the underlying assets. Good luck with that. Mm-hmm. And as foreigners wake up to this, the situation is going to get worse. Mm-hmm. It really is.
Alasdair, how does that translate now into, let's say the growth of an economy? Many companies have gotten so used to taking on debt to be able to grow, to be able to facilitate continuing to operate. So if we see the continued rise of the yield of, particularly US debt, how does that affect these companies' ability to actually have access to capital and continue to operate?
Well, I think increasing numbers of them become zombies and then, go into bankruptcy. And of course, that's not popular with the political class. And of course, the Fed would come under enormous pressure. It'd be irresistible pressure to push interest rates down, which will crucify the dollar. Yeah, I mean, if you're going to, the only thing holding up the dollar where it is at the moment is the Fed funds rate, basically, and you get a similar amount of return on T-bills. So that's the only thing holding it up at the moment. If as time goes on at these rates of interest, particularly after everybody took out so much debt when we had zero rates, zero interest rate policy, they just took out debt, not because they actually had a sort of productive use of it, but just for the hell of it. I mean, why not borrow? It was wonderful. And you saw the regional banks who were stupid enough to think that interest rates were never going to rise. And what happened? They got killed. Mm-hmm. And property, commercial real estate, same problem. And that's going to be a problem which the banks have got to absorb and are absorbing at the moment. The quantity of zombies is increasing over time, just increasing and increasing and increasing. The whole of the economy is sort of just sinking under this debt. And there is going to come a tipping point. And it's something which William White, who is an ex-central banker at the Bank of International Settlements on a broadcast which I posted on my Substack. He said that the private sector is going to go into debt deflation, and it's then going to be followed by inflation, which is basically, in other words, the debt crisis is going to hit the private sector first, and then it's going to hit the government. And what did government do? They just reduce their interest rates to try and save the private sector. Produce. I mean, you think you've got a deficit of 6% at the moment. I mean, that could easily go well over 10% under those circumstances. And what does that do to the currency? Well, the currencies collapse. Mm-hmm. So, it's that I think is. I think William White's, Bill White's description of how it's likely to pan out is actually pretty good. I'd go along with it.
It's such a slow-moving, gigantic problem. I think what's the nomenclature for it from Nassim Taleb? It's like this is a gray rhino rather than a black swan, right? It's something that you can kind of see coming from a mile away, and you shouldn't necessarily be surprised by it. But the enormity of that problem is, unmistakable. But I think we have this recency bias that we look at the world through that makes us maybe underestimate it or not see it.
Yeah, well, absolutely. And I mean, at the moment, we were, I think, increasingly aware that these are problems coming down the line. But in recent weeks, I mean, everything's just really ground to a halt. Nobody's doing anything. But this is a typical sort of summer lull. I mean, I also see this in terms of subscribers, new subscribers coming into my Substack. I mean, the pace has been, very nice and healthy and all the rest of it. And now it's sort of slowed down substantially. And talking to other people who've been running Substacks for longer than I have, they say, oh, yeah, every summer this happens. Just people just lose interest. And, I think in a sense, totally understandable. Out in the garden, sunbathing, or on the beach, or whatever. So, but later on this year, I mean, I think they'll come back, and I think you'll find also that a lot of the zombies will start falling over. I see no reason why it shouldn't delay beyond the early autumn. I must say, the end of summer.
Mm-hmm. Well, I certainly notice the same in terms of even trying to book guests for the show, because nobody does want to let's say talk about gold or really see anything of consequence happening during the summer here.
Interesting comment. Yeah, it rather supports the whole thing. The whole thing is just sort of going on holiday. But this is a dangerous time because you sort of think the whole thing's gone away, but it hasn't. It hasn't. I've seen this so many times.
Going on vacation and ignoring the problem doesn't make it less.
It doesn't resolve it. No. It doesn't resolve it. You're dead right.
Yeah.
I think the other thing, which I think is very, very important, I mean, I made the comment about foreigners owning 17 trillion in equities. The situation we have is very similar to 1929 in Wall Street. There were two things which I would call out. The first is that you had the roaring 20s, which basically were 26, 27, 28, 29, or more so it was 27, 28, and 29. And that was when credit expanded very, very rapidly, and it fueled into the stock market. It created that bubble. This was the time when you got tips from shoeshine boys and, lift boys and all the rest of it, allegedly. The other thing that happened was you had the Smoot-Hawley Tariff Act, which was signed into law in 1930, but was going through Congress in 1929. Those two things are very similar to what we have today. We have the credit bubble, which you can see in equities. And if you don't know you're in a credit bubble, just look at the debt, because for every credit, there is a debt. We've got a debt bubble. Therefore, we must have a credit bubble. Just a question of where it's going. And it's gone into stocks, basically. So we've got a credit bubble. And then along comes President Trump with his beautiful word, tariffs. And he loves tariffs. And he thinks that this is the solution to making America great again. We're going to shut down foreign enterprises and bring them all back to America. Yeah, sure. But this is Smoot-Hawley Mark II. We have got exactly the same dynamics today that we had in 1929. Do not forget this. This is so important to understand. And the foreigners are going to get the hell out of it as soon as they start seeing stocks falling, because they've got no reason to hold on to US stocks. I mean, it's only speculation from their point of view. They're accounting in their own currencies, not dollars. So you're going to see the dollar being sold down, I think, quite heavily, and underlying investments, and particularly it will be stocks. So once it starts sliding, you're going to get many Black Mondays, Tuesdays, Wednesdays, Thursdays. Not good. You tend to get a rally on Friday because people close bear positions on Fridays.
Just in time for the mini vacation of the weekend, right?
Well, yeah, you book. It's quite simple. If you've got a market that goes down during the week, you take some profits from your bear tack on the Friday and just have a nice relaxed weekend. Knock back the champagne, how clever you are, and all the rest of it. Then you back on Monday, throw out the bears again. And that's sort of what happens.
Excellent, Alasdair. Well, in wrapping up today, is there anything that you'd like to leave our listeners to think about after this conversation?
Well, don't think the problems have gone away. I think that's really the message. And as the other message I've been trying to get over is, this 1929 replay that we have today. And the answer is get out of credit, basically, and get into real money. And real money in everybody's common law is gold, and to a lesser extent, silver. But gold is the one which the central banks are accumulating, and ask yourself why they're accumulating it. It's why are they getting out of the currencies that they print? Well, the answer is they have a vision of the future, which perhaps you might investigate a little bit. And I think, the other thing, I'd like to promote my Substack, because really what I try and do is to educate people, sort of continue to explain to them what is going on. And I think that's very, very important. If you don't understand what's going on, then you're like a child in the wilderness. You really do need to know what you're doing. And it's about wealth preservation, not wealth accumulation. Another very, very important point. Trying to keep what you've got rather than going out and trying to make yet more, because it's all fiat money. fair credit. Keep what you've got.
Mm-hmm. Yeah, there's a ton of excellent articles and all of your interviews there as well. That's all available at alasdairmacleod.substack.com. And of course, you're still on Twitter as well at Macleod Finance. Alasdair, thank you so much for your time today. Appreciate it.
Thank you very much, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.